Managing cash flow begins with understanding one simple idea. Cash is the actual money moving into and out of your business every single day. It's not the same as profit. Profit is an accounting number, while cash flow reflects the real dollars available in your business checking account. That's why many small business owners are surprised when their income statement shows a profit, yet they still don't have enough cash to cover payroll, rent, or other essential expenses. The difference comes down to timing. A business stays alive only if it has enough cash available when bills are due. That's what makes cash flow one of the most important financial metrics for any small business, especially during slow sales periods or economic downturns. To understand cash flow, you need to recognize its three main categories. Operating cash flow comes from your everyday business activities. Investing cash flow involves buying or selling equipment, vehicles, property, or other long-term assets. Financing cash flow includes money from business loans, investors, or additional funds contributed by the owner. You also need to understand the difference between money coming in and money going out. Cash inflows include customer payments, deposits, business loans, grants, tax refunds, and any other money entering the business. Cash outflows include payroll, rent, vendor payments, taxes, inventory purchases, advertising, utilities, software subscriptions, and every other expense paid by the company. Tracking these inflows and outflows every day gives you real control over your finances, because small leaks can quietly grow into major problems if they're ignored. Even a simple spreadsheet or accounting software like QuickBooks can help you spot trends early and avoid unpleasant surprises. One of the most valuable financial reports you can learn to read is the cash flow statement. It shows how much cash your operations generated, how much was invested in assets, and how much came from financing activities. More importantly, it tells you whether your business is creating real cash or simply reporting accounting profits. Payment timing plays a huge role in cash flow. If you pay your suppliers promptly, but your customers take 30, 60, or even 90 days to pay their invoices, your cash position can become strained even when sales are growing. Late customer payments create a hidden problem. Every overdue invoice is essentially an interest-free loan you're giving to your customer. Meanwhile, you may have to rely on a business line of credit or credit cards just to keep paying your own bills. Setting clear payment terms, making online payments easy, and consistently following up on unpaid invoices are simple habits that can significantly improve your cash flow. At the same time, it's important to understand the other side of the equation. Delaying payments to suppliers may provide temporary relief, but it can damage valuable business relationships. Vendors may slow shipments, raise prices, reduce your credit terms, or even place your account on hold. Instead of quietly paying late, it's usually much smarter to negotiate better payment terms before problems arise. Invoice terms such as net 15, net 30, and net 60 determine how long customers have to pay. Choosing terms that don't fit your business can leave you constantly short on cash. Some industries function well with net 30, while others benefit from faster payment schedules like net 10 or payment due upon receipt. Offering early payment incentives can also speed up collections. For example, giving customers a 2% discount if they pay within 10 days instead of the full amount due in 30 days can improve your cash flow enough to outweigh the small reduction in revenue. Another effective strategy is requesting deposits or billing clients at project milestones instead of waiting until the entire project is complete. This approach is widely used in industries like construction, marketing, software development, and consulting because it lowers financial risk while helping fund the work as it progresses. Keeping your personal and business finances completely separate is just as important. Mixing the two creates confusion during tax season, complicates bookkeeping, and makes it much harder to determine whether your business is truly financially healthy. You should also understand the difference between fixed and variable expenses. Fixed costs such as rent, insurance, and salaries remain relatively consistent each month. Variable costs, including materials, payment processing fees, commissions, and shipping, rise and fall with your sales activity. Seasonal businesses face an additional challenge. Industries like tourism, retail, and agriculture often experience predictable swings in revenue throughout the year, making careful planning and cash reserves essential for getting through slower months. The next major skill is cash flow forecasting. Despite how intimidating it sounds, forecasting is simply estimating how much cash you expect to receive and spend over the coming weeks or months. Many business owners avoid forecasting because they think it's complicated, but in reality, it often comes down to estimating expected revenue, expected expenses, and when each payment is likely to occur. Creating monthly cash flow projections allows you to spot potential cash shortages before they become emergencies. If your forecast shows that cash could run low during the third week of the month, you'll still have time to collect outstanding invoices, reduce unnecessary spending, postpone non-essential purchases, or arrange financing before cash becomes a serious problem. Another essential concept in cash flow management is working capital. This is the money your business has available to handle its everyday operations, and it's calculated by subtracting your current liabilities from your current assets. When working capital gets too tight, even a profitable business can have trouble paying bills, making payroll, or covering routine expenses on time. Inventory management has a huge impact on working capital. Buying too much inventory ties up cash and products sitting on shelves, while buying too little can lead to stockouts, unhappy customers, and missed sales opportunities. A healthy inventory turnover rate means your products are selling consistently, bringing cash back into the business instead of collecting dust in storage. One of the biggest cash flow mistakes small retailers, restaurants, and online businesses make is purchasing more inventory than they actually need simply to qualify for bulk discounts. While the discount may look attractive, tying up thousands of dollars in slow-moving inventory often hurts cash flow more than it helps. Recurring subscription costs can quietly create another problem. Many businesses continue paying for software, online services, and memberships they barely use. Individually, these monthly charges seem insignificant, but over the course of a year, they can add up to thousands of dollars, leaving the business with very little return. Regularly reviewing and canceling unnecessary subscriptions is one of the fastest ways to improve cash flow without affecting day-to-day operations. Negotiating with vendors is another strategy that's often overlooked. Many suppliers are willing to offer better pricing, extended payment terms, or discounts for annual agreements, especially if you've built a reliable relationship and maintain a strong payment history. Using modern accounting software can also make cash flow management much easier. Platforms like QuickBooks, Xero, Wave, and Zoho Books automatically connect to your business bank accounts, organize transactions, and reduce the amount of manual bookkeeping required, giving you a much clearer picture of where your money is going. Another habit every small business owner should develop is reconciling bank accounts on a regular basis. Bank reconciliation simply means comparing your accounting records with your actual bank statements to identify mistakes, duplicate transactions, unexpected fees, or unauthorized charges. Keeping your records accurate ensures you're making financial decisions based on real numbers instead of assumptions. If your business is generating sales but your profits aren't growing the way you expected, you'll want to watch the next video. I'll walk you through 5 financial habits that consistently successful business owners practice every single week. They're simple, practical, and often overlooked, yet they can make a significant difference in your profitability over time. If you found this video valuable, be sure to like, subscribe, and share it with another business owner who could benefit from it. Thanks for watching, and I'll see you in the next video.